We are in a bubble, I believe, by almost all of those measures.
If NVIDIA dropped 30% tomorrow, that wouldn't be a correction. That would be a shock. Nearly $2 trillion, gone within hours. Not gradually, not quietly, but all at once. Because NVIDIA is no longer just a chip company. It's become something much bigger than that. It has become one of the core engines driving the entire modern market. Today, NVIDIA sits among the largest companies in the S&P 500. A position that usually takes decades to reach, NVIDIA got there in just a few years. Its weight inside the index is large enough that when NVIDIA moves, the benchmark moves with it. When a company this size sells off, the index has no choice but to follow. And once the index starts falling, it doesn't just affect NVIDIA investors. It affects everyone. Because once the index starts dropping, another force kicks in. One that doesn't think, doesn't hesitate, doesn't wait to see if the sell-off makes sense. Passive capital. Trillions of dollars sitting in funds that don't pick stocks. They just track whatever the index does. Today, passive funds control more than half of all US equities. That's not a niche corner of the market. That is the market. And it operates on rules, not judgment. When the index falls, passive funds sell. Not because they're panicking, because that's what the rules say to do. And when trillions of dollars are all following the same rule book, a single large move can trigger a chain reaction that spreads far beyond where it started. Here's the irony at the center of all this. Passive investing was designed to be the safe option, but the strategy built to reduce risk carries a hidden assumption that the market it's tracking isn't being held up by just a handful of names. When concentration gets high enough, the safety net can start looking more like a trap. A fall in one place becomes a fall everywhere, because algorithms don't pause to reassess. They detect a condition, and they execute. When certain price levels break, stop losses trigger, margin calls fire, and suddenly trillions of dollars are being repositioned automatically. No panic, no emotion, no debate, just execution. Human sell-offs hesitate, algorithms don't. Over the past 2 years, retail investors poured billions into AI stocks. For many portfolios, a handful of companies dominate the position. Those names powered most of the gains. But when those leaders start falling, it's a confidence crack. And fear spreads faster than any fundamental analysis. In markets, volatility feeds on itself. Rising uncertainty drives more hedging. Modern markets are deeply interconnected. Through ETFs, derivatives, and algorithmic trading, a disruption in one company ripples outward through the system. NVIDIA is no longer just a company that makes chips. It has become a node in a global financial network, which means its instability belongs to the system. None of this means the AI revolution isn't real. The technology is real, but markets move in cycles. Expectations move faster than reality. Markets run on expectations, on liquidity, and positioning. When those three shift, the market reprices fast. Even the strongest trends can break without warning, often when everything still looks perfectly fine. Thank you for watching. I appreciate you taking the time to think through this with me.